Friends, welcome to Adda 24/7. We are in MCQ series for BFM in Module A, and today we will be covering some important questions in that. Here, I have covered some of them in the master class, okay, on Sunday. Some of them last Monday, okay, means 2nd of July. Kindly follow those videos again. 2nd of July, then BFM this Sunday in master class, and today we are covering it again. Okay, so module A questions we are covering today is the class 2 actually of the MCQs. Okay, so let's start. Directly we'll start without any introduction, nothing. Directly to the topic we'll hit it, isn't it? So that's better, isn't it? Why should I waste much of your time in other things? Okay, let's start. Chalo. Which of the following features of a derivative is not correct? Now firstly, what are derivatives? Firstly, understand that what are derivatives. Derivatives means basically these are derived from something. Okay, suppose if I am having, let's say, Reliance share, Reliance, okay, then what are derivatives? Reliance share I am having, derivatives means either I will buy call or put. So one thing always remember, if I am long on Reliance, long means what? I have brought Reliance, okay, I have brought Reliance and kept it with me, and I will be selling it when the rate goes up. So that is known as a long position. So if I am long on Reliance, okay, I will give you one more detail about this. Long means what? Buy now and sell later. Of course at a higher rate, isn't it? Nobody is a fool to sell at a lower rate, right? So buy now, sell later. This is the long position. So whenever I am long on any commodity, any stock, any Nifty, any dollar, anything, I must buy the reverse option. So what is that reverse option? I will buy a put option. Put, I will buy. Okay. Put is always when the rate goes down, the put earns. Okay. So that is derivative basically. Derivative means basically what? It is used for hedging. Means if Reliance goes down, then what? I'll be in a loss. To cover up that loss, I'll buy this put option. Okay. So, which of the following features of derivative is not correct? So, derivatives are instruments that mature in future. So, is it for future? Let's see. Derivatives help to neutralize the risk to acceptable levels. Neutralize the risk. Derivatives derive value from the market conditions. And none of these. So which of them is not true? Very important one. Which of them is not true? Derivatives derive, see here, go through each one. Take your own time. I'll wait over here. Okay? I'll wait over here. So, what is the correct answer? See this. Derivatives are instruments that mature in future. Obviously, correct. They mature in future. Okay? You will say, sir, we don't know derivatives. So we haven't seen derivatives as of now. Okay, so let me show you, okay, how the derivatives work actually. What are derivatives? Okay, I'll show you directly Nifty option chain. Okay, hold on. See this. Yeah, just let me take you there. See, this is known as Nifty option chain. This is a derivative chain actually. See this. Here it is called as calls. Here it is called as puts. So these are derivatives. This is known as strike price. Strike price means the price for which I buy. I target this price. Okay. Then LTP means this is known as a market price. Okay. This is also known as a market price. Remember, two things are there: call and put. Okay. When the call price, the strike price of the call is lower, see this, if it is 19,500 is the strike price, and present day Nifty, right now Nifty is at this point, where there is the distinction between this gray and the white area. This line is known as at the money. This gray area is known as in the money. Now when the strike price is less than the market price, it is known as in the money in calls. And reverse thing is true about puts. Okay, so that's why Understand this concept very well. This is strike price, this is in the money, this is at the money, this is out of money. Similarly over here, put is always the reverse of call. Okay, so now we got it, some idea. Of course, you can't get complete knowledge of this call and put in just one lecture. Okay, so that is itself a big thing. So that's why, which of the following features are not the features of the derivatives? So they are for the future. As I showed you, this strike price is always for the future. Again, second, they neutralize the risk to the acceptable levels. Obviously, they neutralize the risk. Means what? See this. Reliance, I have brought it for long position. I have brought it at, let's say, 2500, and I am expecting it to go to 3000. So I will be selling it at 3000. But if it goes down below 2500, it starts moving towards 2000, then I am at loss. So to neutralize that risk, I will buy the put option. So this put option means derivative actually. So it is used to neutralize the risk. That's correct. Derivatives derive value from the market condition. This is something dicey. This is wrong. This is not true. Okay. Derivatives always derive the value from the commodity. Okay. They don't have their own existence. Derivatives derive the value from the commodity. Means what? Suppose if I am having Reliance share, so Reliance share is known as commodity. And what is put option then? This put option derives the value from Reliance share. It doesn't have its own existence. So for existence of any call or put or swap, there are various types of derivatives. For any type of option, derivative, the commodity should be there. It can be Reliance, it can be dollar, it can be gold, it can be agri products, it can be anything. So the answer is C. Okay, is not true, that is C. Next one. Which of the following is a derivative instrument in the foreign exchange market? Is, now we want is. Okay, everyone pay attention. Forward contracts, currency options, currency swaps, forward rate agreements, and futures. So which of them is a derivative instrument? We want is. Forward, currency options, currency swaps, for FRAs, and future rates, futures. Now what are these? You'll again say, sir, we have only heard about options, not heard about, and futures somewhere we have heard. We don't know details, but we have heard about this. But we have actually not heard about swaps. This forward contracts you know, or currency options, yeah, somewhere you know. FRA we don't know. See here, it's very simple. I'll give you just one liner over here how it works. Okay, in one line I'll explain you. Okay. So the point over here is, remember, forward contracts, you know, you have done this in JIB also. Means we book the forward rate for dollar. Today, August, September, this is July. So August rate is this much, September rate is this much. That is all you know, right? In Forex you have done. Options mean, just now I told you currency options, put and call. Two options are there. Put means always going down will benefit. Always remember this. Put going down will benefit, and call going up will benefit. Always remember this. Okay. Currency options. What are swaps? Swaps, always I'll tell you, one line you will understand swaps. Throughout your life you will understand swaps. Swap will always have two legs. Always remember this. Two legs. One leg will always be fixed. Fixed means no change in that. And other leg will always be floating. Floating means what? I'll give you an example. From there you will understand. Suppose if I take 1 lakh from you, 1 lakh I'll take it, okay, from you, and guarantee you 7% rate of interest. And what do? I take this 1 lakh from you, guarantee you 7% of rate of interest, and I invest this in stock market. Stocks. So what will happen? This 7% is fixed. I have to give you at any cost. Okay. But what about these stocks? These stocks may give me at least 50% also, or 0% also, or minus 50% also. Anything can happen. So this is floating. So swaps always mean there are two legs. One is fixed, second is floating. Okay. This much is enough as of now. FRA, forward rate agreement. These are separate. Here always interests are exchanged. Here always remember, the difference between the interest rate is always exchanged. Difference, okay? interest rate difference is always exchanged. Difference, okay? So that is always exchanged. Always remember this. So FRA means basic one line definition of FRA is enough. Interest rate difference is exchange. Means what? Suppose if we decide that okay, after 1 year FD rates will be, suppose let's say today the FD rates are, let's say, what, 7%. After 1 year, if myself and yourself start betting that here after 1 year this FD rates will be, I'll say, 9%, and you are saying after 1 year the FD rates will be 5%, they'll go down. I am saying go up. So at the end of 1 year, when actually the things happen, so we'll check the difference in our interest rate where the actual FD rates are, and then we'll subtract from our figures and then adjust the money. If from 7% they have gone to 8%, okay, so it's in my favor because I had told you 9%. So what will I do? 9 minus 8, 1%. So that much I'll give you. And what will you do? You had told me 5%. So 5 plus 3, 8. So you will give me 3%. So in net what has happened? I have gained 2% in this. I have given you 1 and gained 3. So that is basically FRA. Okay, clear? Now see here, it is too deep as such. I am just giving you one simple example for in a common layman language. Okay, so that is basically FRA. So again, coming back, which of the following is a derivative instrument? All of them: forward, currency options, swaps, FRA, and futures. What are futures? Futures and forwards are same. Only the difference is in future there is a third party involved. In forward there is no third party involved. Forward is always called as OTC product, over the counter. It is between the buyer and the seller. And in future what happens? There is a third party, like shares. Suppose if you buy let's say Reliance shares. Do you know who is the seller? Have you ever met that seller from whom you buy those shares? Never. Because there is NSE and BSE in between. So that is known as a future. That logic is known as future. Means there is always a third party who does not let the buyer and seller to meet. And important is they always control the market. Settlement risk is controlled. Okay. So coming back, enough of the gyan to you. Question number 2, answer is what? 1 to 5 all. Clear? Simple. Okay. So these one-liner differences which I gave you, remember these differences for the lifetime. I'll tell you. SAPs, fixed and floating, 2 legs. FRA, interest rate difference. Only this is the throughout your life. Even if you remember this much, that is enough. Derivatives are used for making profits, eliminating losses, managing risks, and all of the above. What is the answer? Making profits. Derivatives used for making the profits? See here, they can be used. Some of the people in the options market do use it, but from the bank's perspective, bank never uses derivative for making profits. Bank never. In present market, many of you also might be playing the options, right? Futures and options. You buy that call and when the rate goes up, you sell that call. So that is for profits. But that is, after all, what? That is not a hedging part. That is the profit taking part, and that is what you are betting. So that's why banks don't deal in that. Banks always deal in derivatives for not making the profits. Eliminating losses, that is not possible. Suppose let's say again the same example I'll give you. Reliance. I have brought it for 2500. Let me say Reliance over here. Reliance. I brought it for 2500. Expecting it to go to 3000. Okay. So if it starts going down to 2000. So can I eliminate this loss? Not at all. I can't eliminate this. This loss is going to happen. So I can change this. What can I change? I can manage that risk. Means I can just buy the put option over here. Put. By buying the put, what happens? If this Reliance goes down, my put option will go on increasing. That will rise. The price of my put will go up. Okay. So that is the basic logic. Always remember. In derivatives are used to manage that risk. They can't eliminate the losses. They can't make the profits. Profits can be made only if you play as a gamble over here. Only in that case you can play. Okay. So no, next one. An unplanned event with the financial consequences resulting in loss or reduced profit is called as. Very simple answer. Loss, reduced profit, risk and derivative. What is the answer? Tell me. Unplanned event. See this. Unplanned event. Unplanned means which you don't know. What is going to come you don't know. With the financial consequences means it must result in your financial losses. Then only there is an effect. If something arises and gives you the profit, then you won't say it financial consequence. You will say okay, done, very good, isn't it? So unplanned event with financial consequences resulting in losses or reduced profit is known as what? Loss, reduced profit, derivative or risk. Derivative is totally different. Derivative is the instrument to manage that risk, isn't it? It's not the event itself. It's an instrument to manage that event. So that is out. Reduced profit, it's already mentioned over the reduced profit, so that is out. Loss already mentioned, so this is the right answer. Risk. What is risk? Okay, let me ask you one question regarding risk. Let me see. Suppose if some person goes on the 5th floor of a building. Everyone pay attention. Some person goes on the 5th floor of the building and says he is going to jump. Is there any risk involved in it? He is going to jump. Is there any risk involved in it? Just type in the comment section. How many of you say there is a risk involved in it? Jumping from the 5th floor of a building. What do you say? There is no risk involved. Why no risk involved? Because here, what is risk? It is uncertainty, unplanned event, uncertainty. The important part about risk is uncertainty. Okay, it should be uncertain. I don't know what is going to happen. Then only it's called as a risk. If I know somebody is jumping from the 5th floor, I know he is going to die. He or she is going to die. So there's no point in this. Suppose if I say I am investing in some cheat fund, whom I don't know at all, or investing in those games all we have nowadays. Just pay 10,000 and earn 1 lakh. All those ads you get. You invest over there. You are surely going to lose your money. There is no risk involved in it. Risk happens when there is an uncertainty whether it will go up or whether it will go down. If there Reliance share, same examples here. I generally give the same example throughout because you must understand that concept. Reliance share, I buy it at 2500. So I don't know whether it will go up at 3000 or whether it will go down at 2000. I've just calculated the risk, done the rough calculations, and then bought that share with some expectation. So that is known as risk. Risk is always calculated. It's not blind. Suppose if somebody goes in front of a train, running train, and stands, surely is going to die, isn't it? But obvious. Somebody is going to invest in FDs. Okay. What is the problem? There is no risk involved. FD of whom? Of course of some nationalized or commercial bank. Some lower level bank, if somebody invests, then definitely about to go down. So if somebody invests in some FDs, big FD, nationalized banks, so there is no risk involved, but there is also no return involved. You also know what are the returns in FDs now, right? But if somebody is going to invest in stock market, then there is a risk involved because the returns may go up or returns may go down. You don't know, isn't it? So that is the point. Risk means always uncertainty. There should always be an uncertain event. Okay. Before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material, live classes, ebooks, tests, everything. Whatever you need for your JIB and CIB preparation, you will get it over here. So immediately download it. What are you waiting for? Isn't it? Because here, whatever you get at a lowest cost, whatever you get at a free, so definitely grab it, isn't it? Next. When the sale of foreign currency is more than the purchase of foreign currency, this will lead to close position, long position, open position, short position. What is this? Sale is more than the purchase. Sale is more. Look at this. Sale more than the purchase. underline these three words: sale greater than purchase. So when such thing happens, what is the answer? Closed, long, open, short. See here, one thing I'll tell you. Now there are two answers which are similar over here, or somebody can write answers. But in exam you have to select the appropriate answer, most appropriate answer. Closed position is wrong. Closed means what? Nothing is opening. Whenever sale equals to purchase, remember, I have sold $100, I have purchased $100. So equated. So that this is known as a closed position. Long means what? Okay, I'll come to this long later. But okay, let me explain it now only. If my purchase is more than the sale, see here, sale is more than purchase over here. If purchase is more than the sale, then it is called as long. Long. Whereas the reverse position, sale is more than the purchase, it's called as short. This is short position. Okay, so this is short. And what is open position? Open position is correct. See this, that's what I said. There are two answers available over here. One is this short, D, or second is this C, open position. Open means what? Open position can be in terms of long also, in terms of short also. Open means what? Either I am having more purchases or I am having more sales. In both the things, there will be a mismatch between the buying and selling. So that is definitely an open position, but that is not expected answer. What you have to answer is the most closest answer or most appropriate answer. So the most appropriate answer over here is D, short position. Okay, so C can't be the answer, even though C is correct from that perspective. So in exam, they might ask you such questions over here. Open position can also be given to you. Open is but obvious open. Everything is open position. Whenever you have more long or more short, it's an open position. Okay. Reverse one. When the purchase of foreign currency is more than the sale of the foreign currency, then this will lead to. Now this everyone should answer. Closed, long, open, and short. Just answer this A, B, C, or D. Just now I gave you this example. See this. Purchase, buy is more than sell. B greater than, more than, right? Sale, S. So if B is more than S, that is called as what? Just now I told you, long, isn't it? So that is long. Okay. See here, always remember on basic logic about long. Okay. Whenever I buy, suppose I buy this Reliance share today. Buy this Reliance. You will say you are too much in love with Reliance share. No, nothing like that. I am just giving this example because this is known company to all. Even you call anyone on the roadside and ask about Reliance, that guy knows about Reliance. So that's why I have taken this example. If I take some bigger company name, Infosys is also known, but for the roadside guy, many of those guys don't know Infosys, right? But Reliance everyone knows, right? So that's why. Suppose if I take this Reliance share and buy it today at 2500 and I keep it at the EOD. See here, I buy it and keep it at the EOD. EOD means what? I keep it in my end of the day cash, you can say, right? We have this volt cash. Similarly, I keep this in my portfolio at the end of the day. So when I have this, end of the day when I keep that position, that is always known as long position. Reverse is also true. If I sell Reliance share today and I don't buy it again during the daytime, see here, during the daytime whatever we do, that is known as a trading position, intraday. Whereas whatever we do at the end, means we keep it, whatever is a plus and minus at the end of the day, that is known as either long or short. If I brought more Reliance, then it is long. If I sold more Reliance, then it is short. So this case it is what? Bought more than sale. So it is long position, isn't it? So question number 6 is B. More than the sale of the foreign. This same thing I think so, isn't it? If there is an appreciation in the foreign currency rates, in which of the following position the bank incurs loss? This is, yeah. Now 7 and 8 will be related to you. That's what I was saying, 7 and 8 question. If there is appreciation in the foreign currency rates, appreciation means what? Let's say, let me give you an example. Dollar rate is, let's say, dollar is right now, let's say what, 80. Let's consider it 80. It can be anything, 85 also. Let's consider this 80. Why? See here, in which following position the bank incurs the loss? Bank will incur the loss. Okay, forget this bank. Now take yourself. You are here. You will incur the loss. You are here. Okay. You have, let's say, $100 with you. $100 you are having. $100. Okay. You are having dollar in 100, and $1 is at 80 rupees. So you have brought it at 80 rupees and $100. So you have spent how much? 8,000. Now what happens? You have to find out in which position you will incur the losses. Close position, long position, open position, short position. See here, appreciation in the FC rates. Appreciation means the dollar rate goes from 80 to, let's say, 90. Dollar rate goes from 80 to 90. So 90 into 100. So it will be what? 9,000. So in which position? Suppose you are, let me say, if you are having the dollars at 80 rupees, $100 at 80 rupees, you have spent 8,000. So if the dollar rate goes to 90, you are having the dollars. Okay, in which position bank will incur the loss, and there is appreciation. So 80 to 90, the dollar has gone now. Okay, now let's consider this case. You are having the $100. In that case, you have 8,000, and now it goes to 90. You will sell it. So you'll definitely you'll have a profit. Now second case, from 80 the dollar goes to, let's say, 70. Okay, and into 100. So it is what? 7,000 now. So here you are having the loss. So what is the case over here? If the dollar rate goes up, appreciation, here it is given dollar rate is going up. So if you are having the dollar, you'll be profiting. But if you are having the reverse case, means if you are shorted the dollar, means short position if you are having, means, let me take one simple example. In this $80, you are having $100. Now I'll take one case. You have sold $80 here. I'll write it over here. You have sold $80 right now. You are not having the dollar right now, but you have done the short selling. Short selling means what? I can sell anything which I am not having. I can sell anything which I am not having. So if I have sold these $100 at $80, and now the rate goes up, it goes to 90. What will happen? I'll have to square it off. Here, in any market, you have to square off the position. Means if I have sold $100, I will have to buy $100 and square it off the position. 100 should be equalized. So if I have to square it off, I'll have to buy at 90. So what have I done? I've sold at 8,000 and bought at 9,000. So here I'm incurring a loss in short position. So in short position, I'll always lose if the dollar goes up. Always remember, in short position means the currency appreciate. If the currency appreciates and I'm in short position, I'll always lose. So in this case, what will happen? If there is appreciation in the foreign currency rates, in which of the following position the bank will incur the losses? Closed, long, open and short. So the answer is obviously, this is D, not C, D. So answer is obviously D, short position, isn't it? Now how many of you know the papers? Basically many of us who have applied for the CAIIB first time only, they don't know the papers also, many of them. What are the exact names of the papers? Because here these things are very important. What is the syllabus? What are the modules in this? You must know this. See here, the basic framework should be thorough in your mind. Okay. So ABM, BFM, ABFM and BRBL. These are the 4 subjects. Compulsory. Advanced Bank Management, Bank Financial Management, Advanced Bank and Financial Management and Banking Regulation and Business Laws. Out of them, I'll tell you BFM is the toughest one. Toughest one. The worst subject overall is BFM. This one, Where's this? Yeah, see this. The worst subject is BFM. This is the toughest one. Okay. Then remaining papers are okay. Means ABM is also BFM. Then level 2 is ABM. Then level 3 is ABFM and level 4 is BRBL. But it doesn't mean you must undermine these subjects. Paper 3 and 4, oh, easy. Nothing. Never do that. Never do that. Only I am saying why, because here there are too many numericals, too many. BFM almost 50-50, ABM almost 40-60 or roughly 30-70, anything. ABFM roughly 20-80 and BRBL no numericals. So that's why I'm saying BFM the toughest one. Look at the modules: international banking, risk management, treasury, balance sheet. Similarly over here, statistics, HR, credit management, compliance, and remaining you can definitely see. And electives, look at the electives. Electives means rural, HR, IT, central banking and risk. Out of them one you have to select. Select that where you are conversant with. And negative marking, there is no negative marking. Remember this. As of now there is no negative marking. Subjective questions are there in BFM. Subjective means what? Questions without options. You will be given a screen to input the details and a virtual keypad, and you will have to input it. Okay. Next one. If there is appreciation in the now this you everyone will be able to answer. If there is appreciation in the foreign currency rates, in which of the following positions bank makes a profit? Earlier we had loss. Now bank will make a profit when? Again take the same position. Means dollar is at 80, dollar at 80, at 80. Okay, and I have brought how many? $100. Okay, so now the dollar goes to 90. So what will happen? I have spent 8,000 and I am gaining how much? I am gaining 9,000. So here I am gaining, isn't it? Why? Because I am in a long position. So whenever any currency rates appreciates, appreciation of foreign currency rates, in that case I will gain when I am in the long position, and when I am in the short position I will lose if the currency appreciates. Okay. Now let me ask you one question. Okay. Just type the answer. If my dollar rate is, let's say, 80, now the dollar goes to 70. Okay. And I am in a long position. My dollar rate is 80, at which I brought the dollars at 80. Then what happens? This dollar goes to 70. So I am in a long position. So will I gain or lose? So if I am in a long position, will I gain or will I lose in this? I will definitely lose. So whenever I am in a long position and the commodity goes down, then I am at loss. Always remember this. Okay, got it? Move on. To reduce the exchange risk, the banks put in place the following types of limits: daylight and overnight limit, single deal limit, trading position limit, volume limit, and stop loss limit. Now this is basically managing the risk. Okay, you have to manage that risk. How to manage that risk? That is very important. See here, managing the risk. See here, it never happens in any banking that risk can be totally zeroized. It will never happen. Risk will always be there, and because there is risk, that's why we are there, isn't it? Logic is simple. Because there is risk, that's why we knowledgeable persons are required in banks. Otherwise, why are knowledgeable persons required if there is no risk involved? Isn't it? So what can be the answer over here? Managing that risk. Daylight and overnight limit. Daylight means what? In a single day, what is the amount of dollar or what is the amount of commodity transactions this dealer can do? Now who is a dealer? Dealer means that person who is working in the treasury on the front end. Who is the firefighter? Okay. So daylight limit is that. The maximum limit is given to that person. You can deal in a day maximum up to 10 lakhs in a single day, not beyond that. Overnight limit means EOD position. You can keep in your vault or in your whatever vault package is given to you. Vault only we call it. You can keep in your vault at the day end EOD this much amount only. That is known as overnight. Single deal means what? It means that if I want to buy a single bond of some company, maximum amount of bond which I can buy from any company is this only. Otherwise what happens? If some dealer feels that yes, too good, this is a too lucrative offer, this is too good offer, and this bond is surely going to go up. What will that dealer do? The dealer will put his all the money in that single deal, and if that deal doesn't go through, then if it goes down, then whose money is at loss? It dealer is what? Dealer will just say sorry, I made a mistake, but whose money is at loss? The loss is of the common public's money. Whose money do we handle in banks? In banks we handle common person's money, isn't it? So single deal limit, this is the maximum limit. Trading position limit. What is the maximum trading position a dealer can take? Trading position means what? What is the maximum? Same here, single deal and here multiple deals together. How much can I deal in a single sector or in a this trading position per means half an hour? There are various limits taken. Per hour it has been brought down to per half an hour. Per half an hour, how much should be the outstanding for that dealer in the treasury? That level we have gone now. So what is the maximum trading that dealer can do in a single day? Volumes. What is the maximum volume that dealer can handle? Volume means, suppose if I buy some volume, huge amount of volumes. If I am getting some cheap stocks or some cheap bonds, junk bonds we call them. If I am getting those bonds and if I am the dealer, I might feel, yes, this will go, this is right now at $1, this will go to $10 in next 2 weeks. 10 times money. I might buy huge amount of this quantity of that bond. So that is not allowed. Stop loss limit. Same thing. Stop loss means what? Stop loss limit means, keep it very simple about stop loss. Remember, it should automatically get triggered. Automatically means what? Suppose I'll give you again that Reliance example only. Suppose if I buy Reliance at Reliance, okay, I buy it at 2500, okay. Now what happens? I'm expecting what? This Reliance should go to 3000. But what happens? This Reliance starts going down to 2400, 2300, 2200, 20. Where should I stop? It might go to 0. I don't know. It might go to 0. So where should I stop? So I must stop at some level which is bearable to me. The loss should be bearable to me. Means what? I must stop at, let's say, if I can bear the loss of rupees 100 per share. Okay, I can bear 1000. 10 shares I bought. So 1000 I can bear. So here the system should automatically trigger the sell value. Sell or the sell decision. Okay. Sell order if it goes to 2400. So this stop loss limit gets triggered automatically. Okay. So what are to reduce the exchange risks of the bank put in place? What are the types of limits? So all of them: daylight, overnight, single deal, trading position, volume limit, and stop loss limit. All of them are put. Okay. So answer is 1 to 5 all. The bank fixes limit on various transactions in foreign exchange, taking into account which of the following factors? Means the question number 9 limits were given. Daylight, trading, single deal, volume, stop loss, everything was given. But based on what? How do I decide? What are the factors? Is it merchant turnover requirements? Is it trading skills and volumes of the trader itself, dealer itself? Is it the capital base of mine? Or is it the profit requirement of mine? What do you say? What can be the answer for this? Everyone? Just tell me, what can be the answer? All answers seem to be correct. Right? All answers seem to be correct. Everyone will feel, yes, this, what? Merchant turnover requirements? Yes, turnover means how much turnover can be done by that merchant. Merchant means the dealer who is dealing it. Merchant, that's called as turnover. Or even the units turnover can be called as the merchant turnover. So how much turnover is allowed as per my board of directors given instructions? Trading skills and volume means what are the trading skills of the dealer? Suppose if I am the senior dealer, I am dealing since 20 years in the treasury. I know ins and outs of treasury. So I can definitely have higher limits, as we have in our bank also, senior cashier, junior cashier, right? Similarly over here. So same thing can be done, trading skills and volume. mean depending on the trading skills of that person and the volume that person can handle. Capital base. What is the amount of capital I am having? Sure, that is very important. If I don't have money, then how can I trade? It's that simple. Sure, you can make any of the nataks we call, right? Any of the means falsehoods, but you can't make the falsehood of money. Money is purely the currency. This either you have it or either you don't have it. It's that simple. So capital base is very important. How much money I have depends on that. What do I deal? How much transactions do I take? What is the limit I set? And profit requirement. Is profit requirement a part of fixing the limits? Never, ever, never. Never, never, never I will call it. Okay. So which of them taking into account which of the following factors? So profit requirement is not taken into account while fixing the limits, because profit is altogether a different part. Main thing is managing the risk. Main thing is capital. See here, always remember in business, capital is important, right? Capital is important. Where if you don't earn profit, that's okay, but your capital shouldn't get eroded. That's important. So profit requirement is a secondary aspect. First aspect is 1, 2 and 3. So that is A. 1 to 3 only. 4 is not the answer. Profit requirement is not the answer for fixing the limits. Okay. Next one. Which of the following statements is not correct in context of translation exposure? Now what is translation? What is translation exposure? Okay, translation I'll tell you. What is translation? Okay. Suppose if I send you a message right now on WhatsApp in, let's say, Chinese language, Chinese, right? And then ask you that, okay, how was the message? You'll say, I didn't understand anything. Why? Because that was not my language. So what have I to do? What will you ask me the next question? Sir, what you do? Kindly translate this into English or Hindi, and then I'll be able to read it. So what are you doing in translation? Translation is the same over there also, in bank also. Translation means what? We are translating the Chinese language to Indian language. Similarly, if SBI is having a branch in USA, let's say, let me write it this way. SBI is having a branch in USA. Okay, and SBI is in basically India. That is the Indian bank, right? Now, when on 31st March, SBI India has to give the report to RBI. That see, these are all our profits. This was our turnover. All these things, right? So, will SBI India, whenever it gives the returns or files the returns with RBI, will it give this USA figures also, or won't it? What do you say? Should SBI USA be included as a part of the results or P&L of this SBI India also? Of course it has to be. For RBI purpose, we have to include this, because after all SBI USA is existing because of SBI India. Got it point. There is no existence of SBI USA if SBI India doesn't exist. Logic? So that's why SBI US's figures will have to be brought to INR, rupees. Because in India, when SBI India will give the balance sheet to RBI, okay, it will give it in rupees. Now SBI USA is having the figures in what? Dollars. So these dollars need to be converted to rupees notionally. This is called as notional. Always remember, this is notional. Notional means I am just converting the figures of USA, SBI USA to rupees. But am I closing this SBI USA branch? No. Whenever I close this branch and then transfer the amount, that is known as crystallization. This we do it in where? In the foreign exchange bills. Okay. So these two words are always similar. Here, both are one and the same roughly. There also, in crystallization also, you convert the foreign currency liability into local currency liability. Here also I am doing the foreign currency figures, I am giving it the local currency. But the difference is, here the company is going on. There that bill is closed. So that's why translation exposure means it is just a notional figure which is brought into the local currency. So which of the following is not correct? Not, I want not now. Huh? It arises when the banks revalue the assets and liabilities at the end of the financial year. Is it so? Translation exposure comes at the end of the financial year. What do you say? Just now I gave you this example of SBI India giving the returns to SBI to RBI, isn't it? So definitely it will come at the year end, because translation is always done when you have to submit a report to some organization. This is done to consolidate the accounts of all foreign exchange operations. That's right. Consolidate means what? SBI might be having the branch in USA, in UK, right? In UK, some other country as well. So there it is in pounds. SBI, let's say SBI has a branch in somewhere else, some other bank, some other country. So that will be other currency, New Zealand, let's say. So that will be different currency. So all those will have to be brought to rupees. So this is known as consolidation of all the accounts of the foreign exchange. Is whatever foreign accounts I am having. This is not the actual cost or gain, but only notional, as actual loss or gain is booked at the time of actual translation of the exposure, isn't it? Only notional. This is notional. Just now what did I say? It's notional. Means I am not actually closing this USA branch. I am just bringing the figures over here. So all are correct. So if all are correct, which of them is not correct? So answer is D, none of the above. All of them are right. D, all of them. Okay. The dash exposure of a bank affects the bottom line due to the external factors in the market, such as changes in competition, reduction in import duty, reduction in prices, etc. So dash exposure, transaction, translation, operating, and banking exposure. So which one is true? Dash exposure, what do you mean by this? See here, translation exposure, just now I told you that foreign currency is being brought to the local currency. So that is foreign currency, okay? So that is translation. Is there anything foreign currency involved over here? No. So translation is out. Banking exposure, it is totally different. Banking is a vague term, okay? Forget this, D. Only between A and C now. Transaction exposure, changes in competition, reduction in import duty. See this, reduction in import duty, reduction in prices. So this will all result in operating profits. Reduction in price will always result in operating profits. Reduction in import duty will always result in operating profit. It will increase that profit. So the answer becomes C, operating exposure. Okay. So the answer is C over here, operating exposure. Got it clear, everyone? Next one. The dash risk is the risk of failure of a counterparty due to the bankruptcy, closure, or any other reason before the maturity of the contract, thus compelling the bank to cover the contract at an ongoing market prices. So which is this? Credit risk, settlement risk, forex risk, pre-settlement risk. Very difficult one. Not difficult one, tricky one. Okay, it's a tricky one. What is the correct answer? The dash risk is a risk of failure of the counterparty. See here, it's a failure of the counterparty. Means counterparty has failed. Now this question has two parts over here. Failure of the counterparty due to bankruptcy, closure, or any other reason before maturity of the contract. Now this part is over here. Okay. Thus compelling the bank to cover the contract on an ongoing market risk. So here I am compelled to buy it at an ongoing market risk. Means what? I have to bear the loss and buy. Suppose if I had to get some dollars from somebody in USA. Let's say, see this. There is a buyer in USA, buyer, and I am the seller over here. I was to get, let's say, what, $100 or why 100? Let's say $1 lakh. $1 lakh from this buyer, but he has not given me. But I need those $1 lakh because based on this 1 lakh coming in to me on, let's say, today, I had booked some other contract, done some other deal with somebody. So even though this guy has not paid me, I can't forego my deal, or I can't let my deal get cancelled. So what will I do? I'll have to buy $1 lakh from the market now. Market, right? Because this has not come. So I'll have to buy $1 lakh from the market at the existing rate. So I may have to suffer the loss. So this is known as what? This is known as pre-settlement risk. Always remember, this is pre-settlement risk. Pre-settlement means what? Settlement here before the maturity is mentioned, before the maturity of the contract. So that is a pre-settlement risk. Okay, that becomes a part of credit risk actually. Here it is a shortest part of the credit risk. Credit risk is always of the two parts. One is a country risk, second is the counterparty risk. Always remember this. Okay, but the correct answer over here is pre-settlement. A bank in Australia performs its part of the contract by delivering the currency to be delivered by to the counterparty in Germany, other time zone, which fails to deliver the currency to be delivered to them. Now what is the case actually? This is known as what? Credit risk, settlement risk, forex risk, pre-settlement risk. Is it before maturity or something like this? No, what is the case actually? See this. This is an Australian bank and this is German bank. Okay, German bank, this is Australian bank. Now Australia deals in what? AUD, Australian dollars they call it, Australian dollars. Germany deals in what? Germany has their own currency, but now they deal in what? Euro. Okay, because these are all of the part of the Eurozone, right? So they deal in Euro. So what has happened over here? Australian bank has done its parts by delivering the currency to be delivered to its counterpart in Germany. So it has given AUD to this. It has given AUD. Given. Now the German bank has to give the in reverse the euros to this bank. Euros. Right? They have to give these euros, and there is something like this, na? Over years. Yeah. They have to give back these euros, but they have not given. Okay, they have not given. So what has happened? The transaction is not settled then. This guy has given Australian dollars, but the German guy has not given them this euros. So the question over here is, which delivers to fail the currency to be delivered by them. So this is known as what? Credit risk, settlement risk, forex risk, pre-settlement risk. Now we got the question. So what is the answer over here? It is, what did I say? What is not done? What has not been done over here? The transaction has not been settled. So if the transaction is not being settled, then what does it mean? It is a settlement risk. Always remember, this is a settlement risk. Means the settlement has not been done by this German guy. So this is basically the settlement risk. By it to the counterpart in Germany, which fails to deliver the currency to be delivered to them. Now remember one thing over here. There is a slight bit of confusion in many of the minds over here. This can also be called as a credit risk. Why? Because what is credit risk? Credit risk is a counterparty risk. Okay. Counterparty. Counterparty means what? One party delivers to the other party is not able to deliver. So that's why this can be called as a credit risk. But remember, this credit risk over here generally is of means in exam you won't get these two answers over here. Okay, because I'll tell you, settlement risk is also a part of credit risk only. Is also a part of credit risk. But now if I tell you, if in exam you get the question and you get both the answers, credit and settlement, then you have to write the answer as settlement. If you don't have this answer of settlement risk given over here, then you will have to write the credit risk. So remember the logic behind this. We have to go to the closest answer. Closest answer is settlement risk. But if the settlement risk is not given in the exam, they give you only credit risk and remaining these all, and something none of the above in fourth one. So what will you do? You will write the credit risk at that time. But if both are given, then you will write the settlement risk. Okay. Now last one for today. Yeah, before going, also subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting all the latest updates of JIB and CIB, all, everyone. Okay. Plus you'll get what? Free YouTube series. Free YouTube series in the sense, see here, right now what are you saying? You're watching the free YouTube series. So whatever is free, grab it fast. Go for it. Click on that bell icon. Click on the subscribe button. Do it fast. Okay. Now we'll do the last question for today. Temporal or Herstat risk is another name for which of the following risk? Credit, settlement, forex or pre settlement risk. Okay. Okay, I'll change the answer over here. Here instead of forex risk, I'll write systemic risk, because the right answer over here is, actually I've given you. The right answer is systemic risk over here, because Herstat risk is the second name to systemic risk. Now what is this Herstat risk and what is this systemic risk? Look at this. Both have the same name, both mean one and the same. Due to the failure of one bank, Lehman Brothers, everyone knows Lehman Brothers? Lehman Brothers failed in 2008, and that led to the failure of many banks, including the bigger ones. Citibank was in trouble, HSBC was in trouble, Standard Chartered was in trouble, even in India many of the banks were in trouble. So that led to what? Single bank crash led to the failure of many banks. So this is known as systemic risk. Systemic means due to the failure of somebody, single person, all the parties get affected. So that is systemic risk. Then why is it called as Herstat risk? Because Herstat was the first bank in Germany, which failed because of this systemic risk. First time the bank in the world who failed was Herstat Bank in Germany, and that's why it is named under this bank, under the name of that bank itself. So the answer is systemic risk. Okay, got this point? Now see here, let me show you the batches now. See here, the batches which we have. Let me take this. See this. Look at the batches. Okay, Sankalpa batch 3 and CAIIB Mahapack 2. Both of them are available to you. Sankalpa batch 3 starting July 21. Join fast. All the 4 subjects are covered. Numericals, objective questions, case studies, everything is covered. Okay. Compulsory subjects are covered over here. And in Mahapack, if you join, go for the Mahapack. Mahapack, you are getting multiple batches per subject. Plus, what are you getting? You can get you get this live classes, video courses, e-books, test series, mini and Maha marathons, practice papers, doubt sessions, everything you get it over here. How to join this here? There's a code going on right now. There's a huge discount offer going on. Let me show you that. Okay. So in discount offer, go to, let me show you, go to Adda 24/7. Let me take you to Adda 24/7. If you're having the app, I would suggest you to go through the app. Okay, always go through the app, because in app what happens, you get basically the coin system. In coin system what happens, you can earn up to 1% extra. Okay, so go to Adda 24/7. Say this. Let me show you. One sec. See this. Now you are on Adda 24/7. Click on JIB and CIB. Then click on CIB November. Okay. Clicked. You'll see the batches. See this. Click on Sankalp batch 3. You'll see the details. Go through the details. All the product details are given. Importantly, I'll tell you, recorded videos are available. Expert faculties, interactive classes, recorded videos are available, so that if you miss out on any class, you can definitely get back to it. See here, how to buy it. See here, prep 80 code is already applied. So 80% of you are already getting. Buy now. Okay. Click on buy now. See this. Click on buy now. Put the details. Continue. Okay. Fill in your details and done. You get to the batch as such. Okay. Let me see. Yeah. So buy now. Continue. Click on continue. You'll get to the batch as such. Okay. So buy now. Just click on buy now. Done. Similarly, you can go for Mahapack. Now what is Mahapack? Look at this. As I told you, multiple batches per subject. See this. Click on JIB and CIB. Then click on CIB Mahapack. This one. Done. In this Mahapack, you'll see again the details. Go through the product highlights. Live classes for more than 500 plus hours. Case study batches. Detailed subject wise expertise. Recorded videos. include the syllabus of 23, latest one, that is very important. Buy now. Okay, clicked. Look at this. The code is already applied over here. See, this prep 80 code is already applied. You need not apply any code now. 80% off is already there. Click on continue. Look at the details. Buy now. Click on buy now. Done. Continue. Fill in your details and done. It's so easy. Just go on and apply for this, for the batch. Okay, I'll be back tomorrow with another series. Till then, keep studying.